Good afternoon or good morning, ladies and gentlemen, depending on where you are joining us from across the country. Of course, some of you may be joining us from across the pond in parts of UK or Europe. And I want to say good evening to you, and of course, good early morning if any of you are joining us from parts of Asia or Australia. Welcome to today's Power Options Tools presentation on finding new trades and essentially really setting up the search tool for the different strategies that are available. Now, before we begin, for those of you who are new and just joining us out of the blue, welcome. First, we want to discuss what is Power Options. Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Using our tools, you can search across the universe of options to identify only those positions that match your personal risk-reward tolerance in over 23 of the most commonly used option strategies. In each strategy, we do have default searches set up for you to use as a stepping stone to create your own personal search. Now, after the search function, of course, you can quickly do further research and analysis and compare the risk versus reward on your position or against other strategies. We also do offer a powerful set of portfolio tools to help you paper trade, track, and manage your positions as well. In addition to that, we do offer countless educational articles, help videos, archived webinars, and tutorials to help you get more familiar with the tools on the site, and of course the various option strategies as well. Now, Ernie Zarrenner created the Power Options tools back in 1997, so we have over 20 years of business experience, but everyone here at Power Options, including myself, of course, use these tools to trade their personal accounts, so we have many more years of combined trading experience. Now, what we're going to cover today are the features on the search tool and using the search tool and setting up the search tool to potentially match your needs. We won't be able to cover everyone's needs, of course, during the time that we have today, but we're going to give you some ideas and some direction to go with using the search tool for your positions, how to quickly navigate the filters in each strategy. We're, of course, going to take a quick glance at various strategies as well, and we're going to review general tips and suggestions on setting up a search and using the search criteria. And we're going to do that with an eye to two basic questions that I receive on a regular basis. Of course, the first question is, how do I find the best option? The second question is, I have this set of 12 or 13 criteria. Why do I have no results as well? Those are common questions that we get when new customers are trying to interact with the search tool for their specific strategies. All right, well, before we switch over to the Power Options suite of tools and get going, I'm just going to launch two quick polls here. The first one, of course, to help gauge the presentation is I want to know what kind of option strategies are you currently trading right now or paper trading? Are you mainly looking at covered calls and naked puts, sort of parity trades of one another? Are you looking at protective position, married puts, collars, radioactive trading techniques? Are you doing vertical spreads, bear call credits, bull put credits, debit spreads perhaps, or even iron condors? Are you buying options, buying long calls, buying puts, for example, or maybe doing straddles and strangles around earnings? Or are you looking at diagonal or calendar spread positions or other combinations? So we have about 60% of you have voted so far. If you haven't voted yet, I encourage you to do so. I'm going to leave the poll open for maybe another 15-20 seconds or so. Okay. Well, all right. Looks like we're going to have those views there. About 70% have voted. Okay. Joel says he has no audio. Can't say that. Give me 1 second, folks. I'm going to talk to Joel here very quickly. Sorry for the typing, folks. All right, just had to send a quick message to Joel, letting him know that he may need to log off and then log back on. But Bob, thank you. He says his works. All right, let's go ahead and close the poll now. Let me share the results. We almost have representation in every field, but 56% of you are doing vertical spreads, credits and debits. 22% are doing radioactive trades. We'll look at that a little bit as well. 11% are doing covered calls, and 11% are doing calendar spreads. All right, now let me go ahead and hide those results. I'm going to do a quick follow-up poll, and then we're going to jump right in. Last poll of the day, I promise. What do you feel is the most important criteria when looking for a new position? Is it the underlying fundamentals and technicals for the stock, regardless of the strategy? Is it the implied volatility, or looking at other Greeks, for example? Do you focus mainly on the probability for those of you using the credit spreads or the debit spreads? Are you looking for the option with the highest premium? Or do you look at the at-risk or risk-to-reward ratio? Of course, those 20% of you that are doing married puts and collars, you're probably mostly going to gravitate towards that last answer, but I think a lot of us are too, with the at-risk field and the risk-to-reward ratio as well. All right, so we've got about 60, 70, 75% of our votes in. I'm going to leave the poll open for another 10 or 15 seconds. All right, let's go ahead and close that poll, folks, and share the results and jump into the thick of things. So 22% of you feel that the underlying fundamentals or technicals are the most important. Well, that's true. I was going to say that I might answer this poll the same way, honestly. 11% of you look for if the one factor we could choose would be implied volatility of the Greeks. That's your focus. Nobody focuses mostly on the probability. And then we have 11% of you who look for options with the highest premium for sell or the lowest in order to buy. And then, of course, 56% of us are looking at the at-risk or risk-to-reward ratio. Now, real quick, I'm not saying that I'm going against the 56% of you. Many of you know that you've heard before that during these webinars that maybe 50 to 60% of my portfolio is in protected positions, married puts and collars. So I already know what my at-risk and risk-reward ratio is. So my focus really tends to go more, where I spend more time researching tends to go with the underlying fundamentals because I already know my risk up front. Oh, Joel, fantastic. I'm glad you got it now. Just might have been a slip with the connection when you logged in, but Joel's back in and doing good. All right, so with all of that being said, let's hide those results. Okay, and take that into account with what we're doing now. The first thing that we need to consider, of course, when setting up a search is what are we searching for? Now, we had 11% of you doing covered calls, 22% doing married puts and collars, and 56 doing vertical spreads and the calendar spreads. And I have most of those selected, but let's go ahead and change it up a little bit. So first, when you log on to your PowerOptions account, you want to click on Other Strategies. This is going to allow you to customize what we see at the top of the screen. With 56% of you doing the vertical spreads, I'm going to use the arrows here just to move bull put credit up to the top. I'm going to put bear call credit underneath of that. Now we had 22% of us doing married puts and collars. Okay. We'll move that there, and then we're going to take the long collar up as well. 11% of you doing covered calls and naked puts, check, and 11% doing calendar spreads. So we've got that all in there, and we've got our order. Now let's say I wanted to add iron condors or a debit spread. Well, I'm simply going to remove the custom spread tool for the time being from our available list, and then over here on the right, let's go ahead and select, on the left, let's select iron condor. We'll click add to menu and then save the configuration. Now you notice that my tabs up at the top have changed based on our new setup and our new selection. Okay, so let's go ahead and go into bull put credit spread. We'll talk about bull puts first. And you see, of course, when you go into the main home menu, you have some tools section, a learning section, and more. You'll see that in each of the strategies. And then you have the quick navigation where we can go into search or the sample searches. In each strategy, there are sample searches set up for you. And these sample searches are kind of themed searches, similar to what is shown in the main search as the default criteria for you to use as a stepping stone to create your own personal search, but with a little bit more direction. For example, there's one here just on ETFs. So if I wanted to be a little bit more conservative, just look for bull puts or bear calls on ETFs. I'd start there. bull put credits are naturally a bullish strategy, so there's a 5-star search selected for you. And what the 5-star search will do is show you bull put credit spreads only on the stocks rated a 5-star by Standard & Poor's. Okay, so you've got that one as well. And then, of course, the safety first search. And I'll be honest with you, it's a good screen, but it might be boring compared to what some of you are doing. Most of you who are doing credit spreads, I don't have a poll set up for it, but you're probably looking at weekly options or maybe 2 weeks out, and you're probably looking for stocks that offer the higher return. The safety first bull put search, you're going to see large cap stocks in there which might not be offering as high as a return as you can get with some other positions. But the probability will still be there, a decent net credit will still be there, but they're on more conservative stocks. Okay? So those are some of the themes that you can use in any strategy. The sample searches will be available. But let's go directly into the search. And we're going to start off looking for a new position. I'm sorry, hold on 1 second. I just want to make a change here. See if that helps us any. Okay, let me go ahead and pause that. I'm sorry, folks, I didn't realize something. It's not a big deal, but it is. Okay, sorry about that. 1 moment, I apologize, 1 moment. Okay. Much better. There we go, let's refresh that. Okay. All right, so we went into bull put and we went into search. And anytime you access the search, you're going to see a listing of trades that either match our default criteria or your last saved search. So what is the first thing I do when I open a search in any strategy? Well, the first thing I do is I ignore the listed trades and all the numbers, and I'm going to scroll down below the listed trades. And we're going to take a look at the parameter field. Now, as I mentioned, when you first open the search, you'll see the default settings that are available. Anything with a double asterisk is one of the default screens that we have set up for you. Sorry about that. I was in calendar spreads. I don't know why. Switched over to the wrong one. Okay, so we scroll down below the listed trades, and we see here that I'm looking at the weekly bull put default search now. But when you click the drop-down menu, you'll be able to see any other saved searches that you have in addition to the other defaults. Well, what are some of the differences? Well, this weekly bull put, you can see here, is only looking for positions, days to expiration 8 to 17 days out in time. Okay? And then the initial values search will be looking at positions that are more monthly. So it would be looking at the standard February 17th expiration as opposed to weekly options. But most of the stock and the other option criteria are going to be very similar because we're looking for the same thing. Regardless if we're using a monthly bull put or a weekly bull put, you can see here on the right-hand side the active filters that are being used in the options section, the stock technicals, the stock fundamentals, and of course if we're using any lists field as well. So for the weekly search, we're looking for stocks that are trading above their 20-day moving average, have a MACD cross signal where the MACD has crossed the signal line by at least 3 days, with any spread, debit or credit, or maybe even iron condor especially. You want to avoid stocks that have an earnings between now and expiration. I don't want to enter a bull put spread that's 10 days out with earnings coming up in 3 days. If the earnings disappoint for some unknown reason that I couldn't see in a stock chart or any research and analysis, and it falls 20%, well, I'm probably going to take the max loss on that position. I don't want to take that chance. Okay? And of course, in this one here, the weekly series, we're excluding the indexes and ETFs. Why is that? Well, most of these searches that we've created for you to use as a stepping stone to create your own personal search are set up based on historical testing that we found give the best trade-off of time versus the net credit for those positions. A question just came in. If this is a weekly search, why are you looking for 8 to 17 days out in time? It's because when we ran those historical tests for this specific screen, we found we had better results looking 14 days out in time than trading every 3 to 5 days, opening a new position on Monday to close on Friday. The reason why is the credits were lower. You could still get a reasonable return, but once you factored in the wins and the losses and the management, doing it 3 days out or 5 days out had a lower overall return than going about 14 days out in time. So yes, you can still do weekly options. I'll talk about that in a moment. But these results are the starting point of what we would use for a position. Okay, now let's review what is possible in each of the categories. The active filters over here on the right-hand side are showing you just what's being used right now for this default search. Again, we can see that we're looking for a minimum net credit of 15 cents, return greater than 2%, reasonable probability, some volume. But some of those factors that you requested, that you said you were looking for, are not taken into account. We're not looking at implied volatility or the Greeks, for example, right now. And we're not looking at delta, and we're not looking at limiting a strike difference range in specifics. Okay, so these are just the base criteria that are being used, and then we have our technicals. But in every strategy, you're going to see the same setup. When you scroll down below the listed trades, you can start off in the Options tab, where you can set your desired time frame. So if you wanted to look for the options that expire in 2 to 3 days, we could just change this. So I'm going to change my days to expiration. I do have it set to all months, which really means all expirations. And I'm going to limit this to 5 days. So I'm only going to look for spreads now that expires 0 to 5 days. Anytime you make a change in the search, hit the Submit button. Okay, so we want to see first if we have anything. If I go through now and make 3 or 4 other adjustments to my search criteria, and then I click Submit and I have no results, I don't know which really filtered it out. Okay, so there are 2 spreads here that match our default criteria of looking for that 15 cents minimum net credit, probability of 70%, and still are in an uptrend, of course, MACD line, and don't have earnings between now and expiration. Well, regarding the risk reward, let's talk about that for those of you doing credit spreads. Don't worry, we'll get to the other strategies as well. But this particular one is offering a return of only 3.4%. You can't see that if I highlight it. It's offering a return on Chipotle of only 3.4%, but it does offer a 25-cent net credit for a 3-day trade, 2-day trade. And there's a strong probability of it expiring worthless, 91% in fact. But the risk here is pretty high. You're making 25 cents on a 7.5 point spread. This shows me selling the 410 put for Friday and buying the 402.5. The other one is only, on Tesla, is only a 2.5 point spread. And it's offering a credit of 20 cents, so the return is higher. So when talking about the risk versus reward, which 56% of you requested, said would be your primary factor, in relation to a credit spread, a debit spread, how would we set that? Well, there's 2 ways. Okay? Number one, the return for a credit spread is the difference in the strike prices minus the net credit. I'm sorry, is the net credit divided by your difference in strike prices minus the net credit. What you're truly investing in the position, what you're getting back. So a 3.4% return, 25 cents against a 7.5 point spread, that might not help you. That might not match the risk reward you're looking for. So we can set it 2 ways. I can up the return to be at least 8%. Again, we know we're only going to see one result when I submit this. But what you can also do in the credit spreads is set your strike difference. If you preferred to only look for positions that offered a 2-point spread or less, I can just set my strike difference to be less than or equal to 2 or 2.5 or 5 points, so I don't see any of the 10-point, 15-point, or 7.5 spreads. I'm going to set it to 2.5, and of course we know we're only going to see the Tesla position now because the other one had too low of a return and had a strike difference of 750. So that's not going to match our new criteria. Okay, so now we're set with only the Tesla position being available. Now, let's talk about the two things. Let's say you called me up, you're a credit spread investor, and you say, I want to find what is the best credit spread. In all honesty, I cannot answer that question. We currently have about 22, is it? I'm sorry, my apologies. We currently have about 24 people online right now. 56% of you said that you were, 56% of you said you were trading vertical spreads. So what that tells me is, let's say we just took the straight numbers, and let's say we did, 22 people online right now, for example. Well, 11 of you, let's say 13 of you, are trading credit spreads, 56%. Now, of those 13 or so of you, 5 of you are going to tell me that in addition to that, the option premium is the most important. 5 of you are going to tell me that implied volatility and the Greeks are most important when opening a spread position. And probably 7 of you, so I'm at 17 now, are probably going to say that the underlying fundamentals. And then a mixture of those would probably say that, yes, the risk reward is important. We already talked about setting the risk reward. It's going to be based on the return and setting your strike differences with the net credit. We know that if we're only going 2 days out in time to Friday expiration, a better play might be to lower my net credit to 10 cents because we're only 2 days out. There's not a lot of time value. You've got to give a little bit up. Could I find weekly positions that expire in 2 days that have a net credit of 50 cents? Yes, this search tool will find anything that matches any criteria you have. But guess what? It's not going to be 3% out of the money. It's not going to have a 70% probability. So everything kind of works hand in hand when you get down into the nitty-gritty of the search tool. Okay? So if those existed, this tool will find it. But also that stock might not be in an uptrend. It might not have crossed its MACD signal, or it may have earnings between now and expiration. So let's say that this was your goal for your credit spreads. You want to find, well, let me backtrack 1 second, I apologize. So what is the best option trade? That comes down to you and what you're personally looking for. What the best option trade is for you is not going to be the best option trade in the same strategy for me, because I might be focusing more on probability and safety where you're focusing on straight return. Neither one is really wrong. In essence, in any strategy, a combination of all those factors are what's important. So I can guide you to what I think is the best criteria to use for a weekly search in bull puts or bear calls, and we already have that saved for you. That's your starting point, and then you'd make changes off of that. Okay? But let's say you wanted to find positions. You called me up and you say, I want to find bull put credit spreads that expire in 2 days where the strike difference is no more than $2.50, and I want at least a 50-cent net credit. Okay, well, let's start from scratch. How would we do that? If you have a list of criteria, 3 or 4 even, just hit clear filters. Empty everything out of the default parameter field to start with. And we know we want a 2-day trade, so I'm going to set my expiration date, again, from 0 to 4 days, 0 to 5 days. You want a minimum net credit of at least 50 cents. Not even going to worry about return. And you want your strike difference to be less than or equal to 250, for example. Okay? Now, we know some other things that you're going to do. You're not going to trade in the money bull put credit spreads, I hope, where the short option is in the money and you've got a higher probability of getting assigned and taking a loss on the position even though you're taking a higher net credit. So we know we're going to go at least a little bit out of the money. Let's just go 0% out of the money. And I know you're still going to want a probability of maybe 70% or so. Okay, so from scratch, that's where we're starting off as well. Okay? Oh, Bob made a comment here. He said, I would afraid you would say that I'm the weakest link in the chain. No, you're not, Bob. Not at all. It has nothing to do with that. What I'm saying simply, and we're going to get more in depth into this, I have thoughts on what I feel is the best trade in a given strategy or the best search criteria to use. And if you're doing weekly options, based on our historical testing, I feel that default criteria there that we set, that we started looking at originally, is the best place to start for a weekly bull put or a weekly bear call. Okay? Honestly, that's my opinion on the position. And then you can customize it. We could have started with the weekly bull put, Bob, and you could have seen those results and said, well, most of these only have a probability. The higher return ones only have a probability of 71 or 72. I don't want to trade it unless it's a probability above 77. The minute you say that, the minute you look at the results, you say, this one is offered, the ones that are appearing at the bottom of the screen have too low of a net credit, or the return is too low, or the probability is not high enough. Come down into the screen and change it. Make that change based on what you want to see, because this tool is designed to be a time saver. This patented search tool is very powerful and it's a time saver. So why am I going to waste my time looking at positions that match the criteria? And if they only offer a 70% probability, but my goal is to have 77, or my goal is a higher net credit, make the change. Filter down the results. Save you time so you're only seeing the positions that match what you want. But those starting points, those default searches, are a great place to start for a stepping stone. But okay, back to our weekly series. You call me up on the phone, you say, yeah, I want to do weekly bull puts. I have a requirement for a minimum 50-cent net credit. I'm only going to open trades that expire that week. I don't want to open spreads that have more than a $2 or $2.50 strike difference, and I want a good probability of expiring worthless. So without considering anything else, we're just going to put those in, and let's go ahead and submit the search. There is one. Okay, and it's a high return naturally because we're looking for a position with a 50-cent net credit for 2 days. I didn't put in any stock criteria. I didn't put in anything. This is what I mean. This tool may be intimidating at first, but if you have a specific set of criteria that you want to start out with, clear the filters, put those in, and see what comes up first. Okay, so here you've got Google Alphabet at 851.71, and the 842.5 put and the 840 put right now gives you a net credit of 60 cents. It's great, matches your criteria, a 31.6% return with a 75.5% probability. But why is this the only one, other than the fact that it's a high-priced stock? Why is this the only one that matches that? Well, let's take a look. I bet you now, if we go into the Fundamentals tab, and we check that box for earnings not between now and expiration, maybe it'll still be there. Let's see. Nope. So there's one position that matches your criteria for that specific requirements, but now when you say, oh yeah, by the way, I wouldn't want to enter a trade of a position not between now and expiration, we have no results that match our criteria. Okay, so this comes down to a second point. You've put in this criteria for your specific trading needs. You wanted high-priced, high net credit, bull puts, good probability, only 2 to 3 days to expiration, and you have no results. Why? It's not there. Trust me, it's not. We are building 1.1 to 1.4 million bull put credit spreads and bear call credit spreads in the database every 20 minutes. It's looking at everything. Of course, there are only about 450 optionable stocks, indexes, and ETFs. So you call me up and you say, your tool, this is what I get a lot. And it's fine. You're learning the tool, and I expect these questions. But I'll get a phone call, yeah, I just started out on the trial, or I wanted to see these positions. I think your tool is broken because I'm not seeing any results. No, that's not the case. The case is right now, there is nothing out there that matches your criteria. So if this was still your trading plan and your goal, what would I tell you to do next? Well, I tell you have to do one of two things. You're either going to have to lower your probability expectations for this 2-day trade to get the net credit that you want, or you're going to have to give a little bit back on the net credit to keep the probability that you want. We're only using 4 criteria here. Okay, so one of these two, we have to have give and take in one of these if you want to open trades today. So let's try that out. Let's take our net credit down from 50 cents down to 40 cents. And by the way, I'm going to leave that fundamental criteria in there to avoid earnings between now and expiration, because I don't want that. I don't want to see earnings tonight or tomorrow where the stock could drop 15 or 20%, because I'm only doing a 2-day trade. And, you know, I'm not going to get a lot of net credit because of the 2-day trade. I know that. So let's take a look here. We've done that. Let's submit our search. Still nothing. So might have to do both. I might have to take this back down to maybe, let's try 35 cents, and I'm going to lower the probability to 65. keep my strike difference. Now, I'm not saying that this means it's going to be good trades that are found, but now we've got some trades. Okay, there are some here that are just above 70% probability, a couple. Everything else is there, and I had to lower the net credit. So you see where there is one here. Tesla Motors came up, but it didn't come up on our original search because we had to lower the probability. Okay, so the tool is not broken. Everything is here. It just means that what your specific criteria were, you're not going to find anything that matches it. There's got to be give and take. Are these good positions? I see two off the top of my head by personal preference right now I would not trade as a bear call or bull put credit spread, and that's TNA. I don't like to touch a 3 times bull or bear ETF or even a 2 times with a credit spread. Too much volatility, too much movement. Even though the probability shows me I've got a 65-66% chance of it expiring worthless, these can swing very quickly, faster than everything else. See, the TNA is at 105.54 and has moved up 276 today. Well, yesterday this spread wouldn't have even been available because it would have been in the money as a bull put. That's not where I want to be, right? So a lot of volatility. So how would I filter that out? There's 2 ways. First, oh, sorry, there we go. I can go in, the easiest way is just go into the lists field. In the lists field, you can choose to screen against specific stock lists that we've created for you, or you can create your own personal stock list. But I can also choose to exclude anything from the list. And what I'm going to choose to exclude is the leveraged ETFs, 2 times, 3 times bull or bear. So let me just do that and run the screen. Okay, so now those are gone. IWM is still there. It's a standard ETF, not that far out of the money, but that's of course because we're using a shorter time frame. So the 2 questions that come in. What is the best option? You just started Power Options, you schedule a coaching session, you just send us an email and say, I'm looking for weekly bull puts. What is the best option to trade? My answer, Ernie's answer are, they're going to be in this list. You would start with the weekly bull puts. Okay, now we know when we run that default search, we have 15 total results. So which one is the best one? Well, now it comes down to, again, what you want. Remember, you scroll down below and said, okay, Mike told me to go here as a starting point, but I know I don't want to trade any spreads that have more than a $2.50 net credit. So the first thing I'll do is change our strike difference. Okay, and you might even want probabilities higher than 75%. That's fine. Plug it in, make the subtle change. We did a little bit differently this time. I did not increase the net credit or the percent return. I just moved the probability. So now we have 4 results. And so if you ask me which one was the best one, well, I'd say any of these 4 look good based on the historical testing and what we've done in the past. Comes down to you now to figure out which one is the best for the needs. What do we need? We need a stock that's stable and moving up in price. We want to stay above our strike price. If you want to be shorter term, maybe you don't look at the Netflix one, which is 16 days out to February 10th. Maybe just focus on these 3, and those might be the 3 that you would trade today. I'm not making direct recommendations or suggestions. I can't. I just showed you where the stepping stone was that we have historically back-tested, and then you want to make 1 or 2 subtle changes to that field for what you want it to see. Now, let's talk again about what is available, and you'll see it in all of the strategies, and then we'll move on to other strategies. We talked about the time frame. You can go to standard expiration, any standard expiration that you want. You can look at multiple expirations by selecting all months and then setting in the time frame that you want. If I wanted to include weekly options and standard, well, I might put my results from 8 to, let's say, 35 days out in time. So it would include February standard series and anything that's a weekly in between, the 2-week out, 3-week out, 4-week out, and so forth. Okay. For implied volatility, you can put in the range you'd want for the implied volatility for the sell option or the buy option. So 11% of you said you'd look at the Greeks. I'm going to talk about that in a moment too. And the implied volatility ratio. And anytime you don't know what a criteria is, simply hover over that and you'll get a pop-up definition. So the implied volatility ratio is just showing the implied volatility of your sell option versus the buy option. In the risk return fields, you'll see things for the net credit, maximum risk. I'm sorry, I didn't go over this. This is the second way that you can set the strike difference. The easier here in the spreads just to set the strike difference to what you want, but you could also use the maximum risk. That's the monetary risk, the difference in strike prices minus the net credit. So if I put in a monetary risk of less than 240, that means I'm looking essentially for 2.5 point spreads or less and still getting a 10-cent net credit or more. So you could do it either way. It's just easier to use the strike difference than the maximum risk field. And your return factors, of course. We talked about the range in or out of the money. Two ways you can set it are the number of strikes or the percentage range out of the money. I prefer percentage, especially when using weekly options. The number of strikes out refers to the step on a ladder. We're looking at a $240 stock, so the one strike out of the money on the bull put would be the 235. And two strikes would be the 232, or I'm sorry, the 230 if it has 5-point spreads, or 5-point strike differences, okay? So the number of strikes is your steps on a ladder. The percentage is just range against the current stock price. Many customers have asked me about how my requirement is I only want to open bull put spreads that have a delta of less than 0.3. Okay, so you're looking at a 30% delta, which kind of equates to a 70% probability or higher. I tend to use probability more than delta, but if that's your requirement, you can use the short option delta field or the long option delta field to set that. Okay, so you can put in the specific probability that you would want to see. Okay, all right. Okay, and then of course liquidity as well. Now there's other factors. If the Black-Scholes ratio, overvalued or undervalued, in other strategies you'll see the implied volatility versus historical volatility in the option field, and the sell to buy Black-Scholes ratio. And in each strategy you can limit the bid-ask spread or the percentage bid-ask spread. Right? So if you wanted to limit it to bid-ask spreads that were less than 30 cents or less than 20 cents, we would just put that into the field as well. And then of course your liquidity, if you do have a preference to screen for higher volume options, we just put that into the option volume today, total number of contracts traded today, or into the open interest field for the total number of open contracts as well. Okay, so that's a review of what's available in the options. In the technicals, we can set various other things. And we're going to look at that in just a moment as far as combinations. But you could set beta, of course. How does your stock react to the S&P 500? A beta of greater than 1 means it tends to move more frequently than the average of the S&P 500. The percent of 52-week range, if you want to look for stocks that are depressed near the bottom of their range, just look for a 52-week range of less than 10. Or if you want to look for stocks that are at least above the 50 or 60 percentile, we'll just plug that in as well. The average stock volume, a liquidity measure for the stock. What is the average stock volume of the last 90 days? The historical volatility, the volatility of the stock, not the option. For bull put credit spreads, bear call credit spreads, you might want to see something that has less frequency of movement. Maybe a historical volatility of less than 0.50 or 0.6, for example, as well. Okay, and then of course relative strength index, the Bollinger Bands and the Bollinger Band range. I'm going to review this real quick, and Scott, I'll get to your question in just a moment because it's 3 away from where I'm going. The Bollinger Bands is sort of an envelope around the stock based on a 20-day movement. And with the percent bandwidth, that's the range of the Bollinger Bands as well. It's an indication, a little bit of volatility. Low volatility has a smaller bandwidth. Higher volatility or recent breakout would have a much bigger one. Okay, so let's say that I only wanted to see positions where the stock was near the upper range of its upper band. It's been moving up and going up and up because I'm doing a bull put spread. I might look for what's called the percent BB20, the ratio of where the stock is to the upper Bollinger Band or lower Bollinger Band. 50, it's right between the two. So I might look for a range of greater than, let's say, 70. And the bandwidth, I want it to be restricted as a percentage. I want a bandwidth to be less than 50. Now, first, let me see if anything in our results matches that real quick. I'm assuming at least one will. Big assumption. Okay, all 4 of them do. Now let me talk very quickly. Should be set properly, I hope. So I'm going to go to the More Information button. I'm going to go to Big Charts. All right, it is. And this is a 6-month chart, but I'm going to shorten it to a 3-month chart. And this is just sort of an explanation here. The red lines, the orangish red lines on the upper and lower end of the stock ticks, that's your Bollinger Bands. Okay, the line in the middle is the 20-day moving average. So when I requested a position that was in the upper 70 percentile of its Bollinger Band, it would need to be up here at the top. And at the same time, I wanted a bandwidth to be relatively small. This is the bandwidth, the range between the two. Okay, this is a big one here. It had a big move recently, so this probably would have been a bandwidth above maybe 60% or 70% or so on that particular position. Okay, so that's what the Bollinger Bands are. Typically what we look for with stocks is you want something near the upper Bollinger Band that's been moving up. Could I find maybe a good position where the stock has fallen and is now trading near the bottom range of its Bollinger Band because I'm expecting it to come back up? Sure. You could do a search in a bullish strategy looking for stocks that are pressed using the Bollinger Bands or the MACD, which I'm going to talk about in a moment, to look for stocks that have recently fallen but you feel are going to recover and bounce back up. Bottom feeding is sometimes the term used for it. And down here, of course, we have the MACD line, where the blue line, of course, is your MACD, sort of a lagging indicator, but it's something I use, and the red line is what's called the signal line. And for bullish strategies, I usually, as we did with the weekly default search, I want to look for positions where the MACD is crossed above, whether it was even below the divergence line here or above it, but I want to look for stocks that have had a MACD crossover and the MACD line is above the signal line. It's another bullish trend indicator. So the default criteria we had for the weekly bull put, we were only looking for stocks where the MACD has crossed the signal line by at least 3 days. Okay, so if a stock had a percent Bollinger Band 20 of 50, it'd be right in the middle, right on the 20-day moving average. If you look for stocks that had a percent Bollinger Band range of 10, it'd be closer to here, it'd be closer to the bottom one. And of course, at 100 or above 100, the other day when Netflix jumped above the Bollinger Band, this would have had a percent BB20 of, let's say, 110% or 112%. It would have jumped up. So that's how you can use the Bollinger Bands based on the charts. And, of course, the MACD as well. Now, I'd reverse it maybe for a bear call. When I'm looking for a bear call or a bearish strategy, I'd look for positions where the MACD is below the signal line. So if we would have gotten into Netflix here as a bear call spread, would have done pretty good, you know, going down from about 125 to about 120 for that 30-day trade. But then the trend reversed. I wouldn't want to be necessarily in a bull put credit spread, or bear call credit spread, I'm sorry, at this next crossover when the stock started its move back up again. Okay, all right, so let me go ahead and erase that, and let's go back to the search. And I had a couple questions come in while I was yammering. First, to MACD, Scott said, what would you do if you wanted to find the MACD just crossing? It's a tough one, Scott. You won't always find what you want, but it's a specific screen. So let me set up the specific screen. Again, I'll clear the filters. Actually, if anyone has any specific questions about criteria on the credit spreads, go ahead and let me know. I'm actually going to change gears here, Scott. I'm going to look at a different strategy for what you're looking for. But the reason why I'm not going too much over what's available in the technicals or the fundamentals as far as bull puts or bear calls is because the criteria in fundamentals, technicals, and lists are the same in every strategy. Okay, so in the options field is the only criteria that changes. Naturally, the criteria I'm going to see for a bear call or a bull put credit spread are not going to be the same that I'm going to see in a married put or a long call, because you can't calculate a percent return for those strategies. You can for a covered call, cash secured naked put, the naked yield, for example. Net credit doesn't really apply to a married put or a covered call. You'd see a field for option premium or option bid rather than net credit. And of course, for a collar, you'd see net premium, the change between the two. But let's talk about that. Those of you following the radioactive trades, radioactive trading concepts, you asked me what is the best search to use. I just had a conversation about this earlier today. I'm doing a webinar on it tomorrow. You'll get an invite to that. What is the best criteria to use? It's what Ernie and I use. This is the default criteria, radioactive trading sorted by earnings per share growth. This is the list that the criteria, I should say, that Kurt, myself, and Ernie have used that have worked well for us. But if you're doing the protective put strategy, married puts, and you want to do a different stock list, you want to look for different technicals, that's perfectly fine. You can start off the same way of clearing the filters to put in what you want to see, but remember, to effectively approach the radioactive trading techniques, you want to leave these 3 filters in place. You want your put to be at least 150 days out in time. You want your max risk to match your criteria to be in single digits, and you don't want to go more than 20% in the money, and in general, you just want 1 to 2 strikes in the money. You don't want to go too far above that. I'm going to explain more about that in tomorrow's webinar at 12 noon Eastern Time. But we start off with our default criteria, and Scott says, what would you want to do if you wanted to find MACD just crossing the signal line? Actually did this on a webinar a couple weeks ago, but let's go into the technicals. We are looking for stocks here as a default that are trading above their 50-day moving average, and I can put in specifics where maybe here in the historical simple moving average trends, if I just wanted to see a stock that had just crossed its 20-day moving average within the last 2 days or the last 3 days, I can plug that in. For what you want, Scott, a MACD just crossing the signal line, it's the same thing. Here in the MACD cross, I'm going to set that I want it to be over and less than 1 or 2 days. I'm going to use 2 days. Give it some room. Give it some breathing room. Okay, so we're going to only look for stocks, hopefully in our list, where the MACD has just crossed the signal line within the last 2 days. Okay, let me go ahead and submit that. Okay, UBNT. 61.92, 70 put, and probably too deep in the money for my taste with a risk of 8.6%. I'd want to look at the 65 on this stock. But again, let's take a look at the chart, Scott, see what we've got. Okay, so let me go to a 3-month. I'm going to go to just a 2-month chart, actually. Let's make it a little bit better for you to view. So there you go. Of the stocks that match the default criteria for radioactive trade with the criteria that Ernie and I use and looking at the specific stocks in the IBD 50, CanSlim, and so forth, we have UBNT. Man, nice little breakout on the MACD, just crossed in the last 2 days, and a breakout above the Bollinger Band as well. Could be due to earnings, I'm not sure. We'd have to further research that, but that's the setting that you're going to use, and that's the chart that it's going to show you. Scott, let's open up our search a little bit more real quick. Instead of using the default criteria and narrowing it down to just stocks in the IBD 50 and CanSlim, I'm going to take this to no lists. So we're going to look at every optionable stock across the market. It's not going to show us indexes naturally because you can't buy the index, you can't do a married put on it, and we're in the married put strategy. The system knows that in the background. That's why in covered calls you'll never see an index come up because you can't buy the underlying. You would just go into the naked call search if you wanted to do that. Okay, so we're going to take it to no lists, and we're going to keep, let's narrow it down a little, now let's keep it at 2 days, okay? And we're going to keep our other criteria, but I am going to adjust our risk down to less than 8.5%. Well, doesn't matter. Let's keep it at 9. That's irrelevant. So let's open it up, Scott, and see what we've got. Okay, with the other criteria, there are 19 results. Mosaic, Western Digital, IMAX, sorry, Sotheby's, Kate Spade. Why didn't we see these other ones? It's because the best results we have found over the years for the radioactive technique are stocks in the IBD 50 and CanSlim. These other ones didn't appear because they weren't in that list. Okay. Okay. I want to go back to another question and to do that. So for married puts, those 22% of you, start with the radioactive sorting by EPSG. We already showed Scott how we could change that if he was one of the ones doing this strategy or others. That's how you'd use the MACD. But adjust criteria based on what risk you want to see. And the only other thing I would change here is in the fundamentals, what stock price range you want to see. So I just made 2 changes. I lowered my risk to 7.5%, look for stocks under $85. This is the list I would choose from if I'm opening a position today, and there's UBNT in there again. Going to contemplate that one, but I'm opening a live trade in tomorrow's webinar, so that's what we'll look at for the radioactive trading. To address Bob's question, I'm going to go to covered calls now. Just as we did before, there's a little feature here to help you guys out. For those of you that are doing covered calls, and if you don't want to interact with a search, you do have sample searches. If you want to look for, again, let's take a look at them. Positions that broker and advisor recommended, a covered call screen for ETFs. We're not saying these are better searches. What we're saying is that if you wanted to look at dividend-paying stocks that are in the money for covered call opportunities, you'd start off with a sample search. Use that as your stepping stone to adjust some criteria. If you wanted to look at low price stocks, we've got the 25 report. It's stocks under $25 that are still above their 50-day moving average and still offer at least a 3% return. Okay. In the search tool, you can set up your own search, but just as we saw with the weekly bull put spread that had been tested, and why are we looking at 8 to 17 days? Because we found better results over time. We have developed something called the picks of the day. For covered calls right now and naked puts, Ernie put together the picks of the day screen, which shows you the top 3 or top 2 or 3 positions that match his historically tested views to maximize return. So there's the standard picks of the day, which are out to February 17, and you also have the weekly picks of the day as well. So these are ones that are for 3 days out in time. Typically, we'd open the position on Monday, and you can, over here in both naked puts, and covered calls, click the link to see how he developed these results, and it'll show you exactly what he did for his historical testing, how he managed the positions in the historical testing, and the results of the weekly covered call and the weekly naked put and the monthly covered call. So this is a quick and easy way for those of you doing covered calls. Now, I want to get to Bob's question. Let me go right into the search for covered calls. And this was a screen we created last time. I'm just going to go to the initial value screen, standard monthly screen that's different than the picks of the day. There's only 27 results. We see some things that we did see also matching bullish, neutral to bullish criteria for the married put. You know, we saw Infi, we saw Avis is in there as well. What was that one? Kate Spade was in there. That was in that open married put search that we used. Decker's Outdoor, I believe, was as well, because they match the bullish criteria. But to Bob's question, if you're selling premium, which we are doing in a covered call or a cash secured naked put, even the calendar spread, why would you not look at options that have implied volatilities much higher than historical volatility? Well, again, you can. But let's take a look. Let's do that for you, Bob. I'm going to go ahead and clear the results. And let's look at a 14-day out trade. Okay, we're going to do the same 8 to 17 days that we were looking at with our weekly bull puts for this covered call. The IV over HV ratio shows me, of course, when I'm selling premium, if I want the implied volatility to be higher than the historical, I want a ratio of 1. If I have an IV to HV ratio of greater than 1.1, that tells me the implied volatility is at least 10% higher than the stock volatility, which across the market, that would mean that it's considered overvalued. Okay, so you could set that setting. The percent implied volatility range shows you where the option's implied volatility is now compared to where it has been over the life of the option. So when you're selling premium, you probably want something that's maybe in the 80 or 90 percentile. But let's say you were bold. You wanted a much higher IV HV ratio. I'm going to look for ones that are 1.5 or above, an implied volatility ratio of at least 80. And I'm going to go kind of at the money. I don't want to go more than 2 strikes in or more than 2 strikes out of the money, let's say in this example. Not that that means it's the best covered call. I'm just going to do it to restrict the results. Let's go ahead and submit that search. What are the options that have a high IV to HV ratio and are in the higher percentage of their implied volatility range? Well, we see some decent stocks. Cirrus is in there, Yelp, AMD, Decker's Outdoors, FireEye. Okay, so these are some good positions. I don't have the columns selected, but anytime in any search you can go to choose columns there and you can select which ones you want to view. Okay, so, but let's talk about what we're doing with a covered call. Naturally, I'm going to buy stock and I'm going to sell a call. Here's an at the money one for Yelp. Let's just look at the profit and loss chart. So we're getting a good return of 5.6% for a 16-day trade. That's pretty strong. Okay, we want the stock to be trading above 42.50. The stock's almost right there right now at 42.48 to get the maximum return. What's my risk? Well, I'm taking a large risk if the stock falls. I don't have any protection to the downside other than the $2.25 premium I receive. Why is this premium so high? Why isn't every stock have an IV-HV ratio of greater than 1.5, an implied volatility range of 80 for a 7 or 16-day trade? Well, it's likely because something's coming up that the market realizes is an extra risk for this position. So let's check earnings date not between now and expiration. And let's see if our, I'm sorry, what was it? The Yelp position remains in our results. Remember, 16 days out. We still have some results. Yelp is gone. What else is here? T-Mobile's in there with a high implied volatility range. Jazz Pharmaceuticals. All right, so this is what I expect to see. More pharmaceuticals or positions that have maybe lost recently because they had a bad earnings and the stock fell. Goodyear Tire, they recently, I believe, no, they have earnings coming up, but not within 9 days. It's after February 3rd. I think it's February 10th. So these are inflated. But why? It's probably because something has recently happened that caused movement in the stock. And that caused an increase in the implied volatility. So are these trades better? Well, actually, some of these don't have any premiums. Let's go ahead and I'm going to do that real quick before I finish my thought here. Let's go to at least 10 cents. Okay, narrows it down to 23 results here. Kinross Gold, Time Warner, Goodyear. So some news or some event has happened recently or is coming up that's causing the inflation. Now, you're asking me, isn't it always better? Now let's talk about very quickly a portfolio. I'm just going to click on this Agrium one, or Agrium, excuse me. When I'm trading a covered call, what do I want? I want a position that matches my goals for a 7, 10, 30-day trade. I want a stable to neutral stock because I want the stock to be stagnant or moving up in price to get the maximum return, especially if I'm not married to the position. I don't want a stock that fluctuates wildly and has a high historical volatility. Okay? So what I'm getting at is if I find a position, and think about this here. Let's go back. 11% of you said that IV is important, implied volatility IV is important. And the underlying fundamentals were listed, the option premiums were listed, which, you know, naturally a higher option premium is affected by a higher IV, and 56% said the risk reward. Beyond the mathematics of the risk reward, which 56% of you said were the most important, is just the thought process of the strategy itself. A covered call position or a naked put doesn't lend itself to looking for positions that offer an extremely high premium where everything else averages a 1.5% return for a 7 to 10 day trade. There are ones out there that might offer a 5 or 6% return for a 7 to 10 day trade. Why? There's some event coming up which would cause the stock a wild fluctuation, which may work in your favor or may result in larger losses. What I'm getting at is that, to me, honestly, implied volatility is irrelevant in most strategies, because I am more of the opinion, and I'm not saying you're wrong if you focus on IV, believe me, I'm not saying that. I'm saying for the strategies that I use, the married put techniques, if I do a collar spread, if I even do a bear call or a bull put, the implied volatility doesn't matter to me too much, because if the stock matches the underlying criteria we already discussed, where it's moving up, and for a bull put spread where it's moving up, it's a good quality stock, it does not have earnings between now and expiration. It has the probability I want and the range out of the money that I want as well. In addition to the net credit, I'm actually already filtering by IV. I don't care, really, if the market thinks my covered call, my cash secured put is overvalued or undervalued, if it matches my criteria of what I'd want to trade and my goals for my portfolio. Okay? I do have a webinar on that. I invite you to check out. At any time, you can go to free webinars here. Let me go ahead and send you the, oops, sorry folks, www.powerop.com/webinars.asp. And if you go there to the public archive page, click on Options Concepts. Here's my thoughts on implied volatility and the double-edged sword, and of course using power options for the IV. And by the way, one of the reasons I don't specifically look for a high IV over HV, or a high IV ratio, I should say just a high implied volatility in the credit spreads, is because, well, guess what? If the option you're selling is undervalued, the option you're buying is going to be undervalued as well. If the option you're selling is overvalued, the option you're buying is going to be overvalued as well. So they're in the same stock. They have the same historical volatility on the underlying. They'll have different IVs, that's true, but if the option you're selling in a bull put or bear call credit spread is overvalued, the option you're going to have to buy on that same stock is going to be overvalued as well, 99% of the time. where that implied volatility ratio really comes into play, where you're looking for a high IV for the option you're selling and a low IV or lower IV ratio for the option that you're buying, would be in a diagonal spread or a calendar spread. You'd want to buy a 2-month out or 3-month out option that's considered undervalued, and you'd want to sell a near-term option that's considered overvalued to have the time decay in your favor. But when you see that scenario, when you see an option with a high implied volatility, do the research, look at the news, look at the upcoming events, because that volatility is increased for a reason. Something is coming up, or something has just passed that has caused the stock a fluctuation or could cause the stock a fluctuation. And for most of the strategies we're talking about, a covered call, a bull put, bear call credit spread, a naked put, even a calendar spread, it's a 50-50 shot that it's going to go in your direction. If I have earnings coming up and I'm in a bull put, it could do nothing. Okay, so let's say 35%. It could do nothing, very rare. It could gap up 10%, hooray, my bull put's looking better, or it could fall 10 or 15%, in which case I'm probably now at maximum loss for the spread. Not what I want. Okay. Now, I have no statistics to prove that looking for a higher implied volatility or higher implied volatility ratio would work better over time when a covered call, with a naked put, or with even a bull put or bear call credit spread. I just know that over the years I found that using the criteria that match a position, when I'm doing a bull put again, what do I want? I want a stock that's neutral to moving up, doesn't have earnings or any surprises coming up, and it's got to match my time frame, my net credit goals, absolutely, the strike difference range, and my probability. Now I run that search, I've got 25 results. I could now say, well, let me see if any of these are considered overvalued. But remember, in a spread, if the option I'm selling is overvalued, the option I'm buying is probably going to be overvalued too. I'm not getting much of a break there in that scenario. But it still probably offers the net credit and the stocks that I want. So do I really care if the market considers it to be more overvalued or undervalued? And on that topic, very quickly, I'm going to go into the weekly picks of the day, and I'm going to see how we develop these results. And here, Ernie talks about what he looked for the stock and for the option. And we'll take a quicker view at this, but you notice he's just looking at ranges in the money with a good return. And, you know, he wanted liquidity with stocks trading at least 500,000 shares per day above the 20-day moving average and where the MACD was up. And he goes on to talk about other things here, about the testing results and some of the things that he saw or he thought he saw or he wanted to see that didn't come into play. What is missing from this? I know I just went through it very quickly, but what is missing from that entire conversation? There was in the weekly screen, which is also available in the search, the weekly picks of the day, Ernie found that changing the historical volatility, looking for higher historical volatility or looking for higher implied volatility, or looking for options that were consistently overvalued by IV or HV ratio, had no effect at all on the historical testing, or it made it worse. So without even paying an eye to it, he found positions that over the time span there that you can see in those how he developed those results. You can see it there, but there's no criteria for implied volatility, IV over HV, percent implied volatility range, or historical volatility either. Okay? Well, let's take a look. It's probably just because of the criteria. Let's see if any of the 12 results that match the weekly picks of the day right now are considered overvalued. Okay. All right, so about half of them. Half of them are considered overvalued or undervalued. But as a rule of thumb, probably 85% of the positions would be profitable. It's no guarantee that the ones that are considered overvalued are going to be more profitable. Because remember, things with the higher IV, they either just had a recent event or they have an event coming up, or the stock has been fluctuating, and that's why it has the higher IV range. Okay, so that's my opinion on the implied volatility. But as we always mention, Bob, you can do that at any time. If you wanted to screen just for stocks that had the higher IV-HV ratio or seemed overvalued, you can plug that in at any time. And then Bob asks, can you change the sort? Yes, in every strategy over here on the right-hand side, you can see that you can quickly change it if you wanted to screen for highest IV over HV, for example, highest to lowest stock price, range in or out of the money. Anything that you can use in any of the filters, Bob, you would just select that. So I'll change it to % implied volatility range. And let's go ahead and submit that. So it's going to be the same results. I'm just changing the order based on which options are currently at the peak. So YY with the highest return is no longer at top. Now we have Weibo Corp, Cirrus Logic, Herbalife, and Shinari Energy. I probably mispronounced that very badly, but that's what we have. So at any time in any search, right above the active filters, just change the sort results and decide if you want it highest to lowest or lowest to highest as well. All right. Okay, so I think I basically covered everything that I wanted to. Remember, after you've put in your criteria that you want, when you're playing around with a search, just click Save, and that will allow you to put in a name and a description, and then you just want to click Save the search. Now, anytime you go into your strategy, your last saved search would come up as the first listed result. Okay, so you wouldn't have to recreate it each time naturally, but you can then take your saved search that you had, and at any time you can go back in. Always, you can go back to the defaults at any time, even if you save multiple searches. You can adjust the criteria on your search based on market conditions, and when you click the drop-down menu, you'll see those listed there as well. Okay, and remember, of course, using the lists field in every strategy, you can click on Create and Modify List. If you just had a list of 20 to 30 to 40 stocks that you trade against on a regular basis, just create your personal stock list. Once it's created, you select it from the drop-down, and then really you don't need to mess around with the technicals or fundamentals so much anymore because it's your personal stock list. Just set the options criteria for what you'd want for your specific strategy. Okay, well, I'm going to navigate back over and wrap up here with some of the other slides and the commentary, sort of the follow-up commentary. If anyone has any last-minute questions, go ahead and send those in as well. Just, yep, that's where I wanted to be. Hold on one second. Okay. All right, so remember, the basic tips on the search tool. When you're running the search and you don't get any results, and you think that the tool is broken, it's not, you're just going to want to have to adjust some criteria. But coming in brand new, use the default criteria or the sample searches as a stepping stone based on your own personal screen. When you're making an adjustment to the criteria to match your needs, just do one adjustment at a time and then hit the submit button. Remember, we had talked about when we pulled up that weekly search, we wanted to change the net credit to 50 cents to see if there was anything 3 days out or 8 to 17 days out that had 50 cents net credit. We made that change and had 2 results. Had I changed the net credit to 50 cents and then changed the MACD and then changed the Bollinger Band to what I wanted or changed the volume or the liquidity, and I submit the search and no results come up, well, I don't know if it's the Bollinger Band or the MACD or the liquidity or the net credit that caused no results to come up. So when you're making an adjustment from the default searches or the sample search, it's best to use one criteria at a time. And remember, don't feel overwhelmed. Start by reviewing the default criteria that are listed from one of the sample searches or from the default searches. Make sure you know kind of what each one is and what it's looking for, and then never feel that you have to put something into each of the criteria. Just put in what you would want to see or make the adjustments that you would want to see, because you're probably not going to use half the criteria. And I already mentioned that. I don't really use the implied volatility IV ratio, % implied volatility range in most of my searches. I get into that when I do the calendar spreads. I don't use delta that often. I do with calendar spreads. And sometimes with the bull puts or bear calls, you know, looking for a delta of less than 0.3 for a bear call, which equates essentially to a 70% probability or higher. But if you tried to put in everything, something into each of the criteria, you're going to fall into that second question that we had, was why do I have no results? Because your search results are too restrictive. You've got to ease off on them a little bit, open it up a little bit more, make some, you know, assurances. If there were 20 to 30 trades available which offered a $1 net credit for a 2-day trade with a 70%, 75% probability or higher, everyone would be trading them. Okay? They're not there for a reason. It's because that's not what the market's going to give us for a 2-day trade. So you know you have to ease up on the credit. If it's there, this search tool will find it. If that spread exists, this tool will find it, but you wouldn't expect to find it that much. All right, so when we're creating your own search, it's always best to start off with clear these settings. We showed even with that 2-day trade, if we only had 3 or 4 criteria, such as 2 days out, minimum net credit, so forth, and a good probability, we only had a few results. That's fine. Start off with what you want, and if you end up with 120 or 130 results, now start putting new criteria in or increasing the probability range, the net credit range, the option premium, because if you're happy with a 50-cent net credit, you're probably going to be happy with a 60 or 70-cent net credit as well, or increase the fundamentals. Now, again, if you see no stock options match your criteria, you're going to have to ease off on those as well, and always submit your search before saving. If you put in the 10 criteria you want and you click save, well, you don't know what the results are yet. Always submit the search first, see what results are there, and then if you're comfortable with them, that's when you want to save it as well. Okay, and of course use the stock list to screen for ETFs, and you can use the dividend field to search for stocks that have a dividend also. Now, again, some of us, we already talked about this as well, but remember, when you're going into a search, you don't want to take our results necessarily as a recommendation or suggestion. The weekly picks of the day, the monthly picks of the day, those are designed to help you find trades faster. But you want to know what criteria we're using and make sure they match what you want to see. Yes, we historically tested them. Ernie put forward his best results he had from historical testing in those picks of the day. Multiple iterations, almost thousands of iterations he was using, trying to play with different numbers. Would earnings affect or not affect it positively or negatively? Was the change worth it? Did implied volatility do anything? It really didn't. Okay, but make sure that you are selecting underlying securities that match the market sentiment. If you're a bull put spread, you don't want to be in a bearish stock or a stock that's collapsing. If you're looking at covered calls, you don't want to be in a stock that's collapsing. Pick stock criteria that match the strategy. Bullish, newish, bearish, neutral. We look for covered calls. I'm sorry, we look for neutral positions. Sorry, I just saw a question coming in. Bob says, you're available after this webinar for a couple of questions regarding IV. I'm actually not. I apologize, Bob. I've got a meeting at 1:30. I probably won't be back in the office till after 3:30 p.m. Eastern time. Okay. That's I won't be able to talk till later on this afternoon, Bob. I do apologize for that. Okay, but the time frame, we look at weekly, monthly, long-term, have realistic expectations. Again, don't think you can go 2 days out, have a 90% probability of 50-cent net credit and a 31-32% return for a credit spread or an iron condor. They just don't exist. If they do, the search will find it, but if they were there, everyone would be trading them. Okay, just a reminder for those of you, of course, that if you're on your trial right now, the subscription levels we have, the $40 per month, the end-of-day data service, so the updates only come once a day, that's $40 per month. 20-minute delayed service is $60 per month, and you get a discount if you go with the yearly subscription. We also offer the real-time as well. Now, again, if you have a question, you can email us to support@powerop.com. But remember, you can also call us during market hours. Bob, I do apologize that I have that meeting this afternoon. I won't be available till around 3 o'clock, 3:30 Eastern Time. You want to send an email, but remember, anyone who's on a trial, best thing to do is if you have questions, is you can just go underneath the Home tab, click that free coaching session button, and schedule a session for the next available time with either Ernie or myself. And, of course, you can have as many coaching sessions as you want as a trial member or as a subscriber as well. All right, well, ladies and gentlemen, I hope you enjoyed kind of this review of the search tool. I think we covered a lot of information. We did handle a lot of your questions. Again, if anything I covered today did not meet your needs or your expectations for what you wanted to learn on the search tool, send me an email about what your needs are. Give me a call during market hours. Again, I'll be available after 3 p.m. Eastern Time this afternoon, roughly. Or schedule a coaching session, and we can go through it then. Take care, ladies and gentlemen. Have a fantastic remainder of your afternoon. Happy trading. We'll see you soon. Good night.